McGraw-Hill Audio presents The Master Swing Trader, Tools and Techniques to Profit from Outstanding Short-Term Trading Opportunities. Written by Alan S. Farley. Read by Chris Ryan. Chapter 1. Trading the Pattern Cycle. The Path to Trading Power. Swing traders must compete against the best-informed crowd in history. Financial institutions spent decades building expensive barriers to keep their middlemen in the seat of power. The net revolution collapsed this unfortunate scheme and opened the markets to the average investor. Now, anyone with a computer can access breaking news, execute a low-commission trade, and witness the immediate result. Technical analysis has come to the masses as well. The web ensures that everyone knows their highs from their lows, and can identify popular patterns as soon as they appear on their favorite stock charts. Managing information and finding opportunity grow more difficult each day. Common knowledge of any market condition closes the system inefficiency that allows easy profit. But the masses respond slowly and continue to throw money at losing strategies for some time. Swing traders succeed when they recognize changing conditions and stay one step ahead of this restless crowd. This simple task requires great discipline, because they must constantly abandon winning strategies and trade fresh ones as soon as the herd charges in their direction. The markets have grown enormously complex over the past century. Look back at Charles Dow's revelations on trend and reversal in the Wall Street Journal, or read the fascinating accounts of Roaring Twenties trader Jesse Livermore in Edwin Lefebvre's Reminiscences of a Stock Operator. The middlemen of that day pocketed such a large piece of the trading action that only the well-greased elite could profit from most market fluctuations. Imagine a world with no electronic communications networks, derivative markets, or talking heads. Yet the core elements of swing trading and technical analysis have not changed in decades. Stocks still go up or down, with many pullbacks to test support and resistance. New highs continue to generate greed that carries price well past most rational expectations. And modern traders face the same emotional crowd that Livermore did when he played the bucket shops early in the last century. Today's aspirants often confuse execution with opportunity. Rapid placement tools and fast connections promise a level playing field for any individual interested in the markets. Add some high-tech software, and the home office may even rival a glass tower financial house. But these complex systems can short-circuit the most critical requirement for consistent profits: market timing that relies on accuracy rather than speed. And the tremendous ease of execution generates instant karma for errors and washes out traders at the fastest rate in history. When new players first enter this fascinating world, they run quickly to bookshelves and absorb the trading masters. Neophytes must move slowly and protect capital until experience finally awakens knowledge. Over time, trade rewards and tragedies condition the mind to develop the instincts needed for long-term survival. Only then will the journeyman trader finally discover what works and what doesn't in this challenging game. Seasoned traders often carry a flawed and incomplete market reality as well. They limit execution to a few classic setups, rather than build understanding of the entire complex mechanism. When the market fails to offer perfect conditions for their limited strategies, tactics demand that they stand aside and wait. But if they lack strong discipline, the restless mind fills in the missing pieces and encourages bad positions. These narrow tactics may end careers in other ways. If the masses discover their well-worn game, it could stop working completely and leave them with no source of income. The daily demands of trading are so intense that many borderline participants just grow lazy and evolve a self-destructive style. Fatigue sets in as the mind struggles to organize this complex world, and many valuable shades of gray resolve into black and white illusion. In this dangerous view, stock positions become all-or-nothing events, and wish fulfillment distorts vital incoming signals. As hope replaces good judgment, another market loser washes out and looks for a safer hobby. Trading at all skill levels evokes emotions that generate great illusions. Sudden gains convince us that we are invulnerable, while painful losses confirm our ugly imperfection. We then externalize and turn to others who will comfort us as they parrot our point of view, or we try to blame external systems for our failure. After all, everyone knows that market makers steal our money through evil tactics, while bad connections and buggy software keep us from reaping fortunes. The path to modern trading power must allow participants to adapt quickly to new inefficiencies, offer profit opportunities throughout changing conditions, and allow fast, accurate analysis of all system input. It must be powerful enough to short-circuit both mental and emotional trader illusions. This market knowledge must be simple to understand, but provide continuous feedback through all time frames. And it must present a broad context to manage trade setups, risk, and execution through a variety of strategies, including day trading, swing trading, and investment. The hidden market. The vast majority of destabilizing and supportive market energies remain hidden from individual traders. Insiders quietly manipulate news to protect options positions. Analysts push stocks so their trading departments can unload inventory. Operating failures pass through accounting magic and disappear. As a result, market knowledge has limited value unless it meets one important test. It must stand alone as a complete fractal image of all hidden and known information about that market. Traders and investors study markets through price charts. These powerful visual tools offer a common language for all equities, derivatives, and indices. The simplest chart just draws a time price axis and adds each day's closing price as a single point or vertical bar. The connected data points then plot a series of oscillating highs and lows that participants study to predict whether price will move up or down over time. Pattern analysis begins with the simple observation that all market activity reflects itself in the fractal properties of price and volume. These small bits of information create a profound visual representation when tied together into a continuous time series, a display of both current and past outcomes for all interactions of infinite market forces, as seen through the eyes of all participants. In contrast to the cold discipline of fundamental analysis, the pattern analyst's world reeks with lust and intrigue. The markets are about money. No other controlled substance brings out the best and worst of humanity with quite so much intensity. The markets become our lovers, our bosses, and the bullies who beat us up when we were young. As assets shrink or swell, emotions flood in and cloud reason, planning, and self-discipline. Chronic fight-flight impulses emerge to trigger unconscious and often inappropriate buying and selling behavior. Actions initiated through emotional impulse generate oscillations in both price and time that print clearly on charts. The skilled pattern reader observes this unstable behavior and visualizes impending price movement. But successful trade execution requires both accurate prediction and excellent timing. Fortunately, chart patterns work without crystal balls or divine intervention. As a detailed map of all market forces, patterns identify exact trigger points where the swing trader can exploit the emotional crowd. Patterns simplify and condense a vast universe of market interplay into easily recognizable setups. The subsequent analysis actually evokes the subjective right brain processes rather than the cold analytics of the orb's left side. Correct interpretation requires that the swing trader focus intuition on crowd impulses evident within each price chart. Those who divine correctly and apply that knowledge to obtaining profits are truly artists at their core, not masters of science. Edwards and McGee did not invent patterns for their 1948 classic Technical Analysis of Stock Trends. They observed an order within price movement as ancient as the auction place. They also recognized the existence of cyclical crowd behavior throughout all time frames and all markets. Although the individual components are simple and easy to understand, these repeating formations offer the most intriguing predictive methods in the entire financial world. Pattern cycles. The U.S. stock exchanges trade over 9,000 issues each day. Add to that many thousands of emerging exchanges and companies worldwide. On any given day, every bull and bear condition, from euphoria to panic, exists somewhere on the planet. Buried within this universe of volatility and price movement, perfect trade setups wait to be discovered. But how can the speculator consistently tap this deep well of profit without being crushed by information overload or burnout? For many decades, technical traders learned chart interpretation through the concepts of Dow theory, or they studied Edwards and McGee and faithfully memorized the characteristics of familiar price patterns seen daily on their favorite stocks or futures. These speculators were a minority within the investment community, and their size allowed them to execute effective strategies that capitalized on these little-known patterns when they appeared. Net connectivity revolutionizes public access to price charts. They no longer require an expensive subscription, and most market participants can view them quickly in real time. Now everyone reads the charts and believes that he or she understands the inner secrets of technical analysis. As noted earlier in this chapter, common knowledge of any market condition closes the system inefficiency that allows easy profit from it. Triangles, flags, and double tops now belong to the masses and are often undependable to trade through old methods. Fortunately, the popularity of chart reading opens a new and powerful inefficiency for swing traders to manipulate. They can use the crowd's limited pattern knowledge for their own profit. The new disciples of technical analysis tend to focus on those few patterns that have worked well over the past century. Skilled traders can place themselves on the other side of popular interpretation and fade those setups with pattern failure tactics. More importantly, they can master the unified structure that underlies all pattern development and awaken the skills required to successfully trade dependable setups that have no name or adoring crowd. Pattern cycles recognize that markets travel through repeated bull and bear conditions in all time frames. Trends uncoil in a predictable manner, while constricted ranges print common shapes. Measurable characteristics distinguish each opportunity phase from uptrend to downtrend and back again. Most participants see these changes as the typical top, bottom, and congestion patterns. But a far richer trading world exists. The twin engines of greed and fear fuel the creation of market opportunity. Through their power, the crowd reacts in a predictable manner at every stage of price development. Prices fall, and fear releases discounted equities into patient value hands. Prices rise, and mindless greed bids up hot shares into the pockets of momentum players. On and on it goes, through all markets and time frames. Rising prices attract greed. Paper profits distort self-image and foster inappropriate use of margin. The addictive thrill of a rally draws in many participants looking for a quick buck. More jump on board just to take a joyride in the market's amusement park. But greed-driven rallies will continue only as long as the greater fool mechanism holds. Eventually, growing excitement closes the mind to negative news as the crowd recognizes only positive reinforcement. Momentum fades, and the uptrend finally ends. Falling prices awaken fear. The rational mind sets artificial limits as profits evaporate or losses deepen. Corrections repeatedly pierce these thin boundaries and force animal instinct to replace reason. Negative emotions build quickly as pockets empty. Personality flaws invade the psyche of the wounded long, while sudden short-covering rallies raise false hopes and increase pain. The subsequent decline finally becomes unbearable, and the tortured shareholder sells, just as the market reverses. The emotional crowd generates constant price imbalances that swing traders can exploit. But successful execution requires precision in both time and direction. Fortunately, this chaotic world of price change masks the orderly pattern cycle structure that generates accurate prediction and profitable opportunities through all market conditions. This inner order frees the mind, provides continuous feedback, and empowers spontaneous execution of rewarding trades. Swing traders capitalize on the emotions of others after they control their own. Pattern cycles caution them to stand apart from the crowd at all times. In the simplest terms, it represents the attractive prey from which their livelihood is made. And just as a wildcat stalks the herd's edge looking for a vulnerable meal, the swing trader must recognize opportunity by watching the daily grind of price swings, volume spikes, and market noise. Prices trend only 15 to 20% of the time through all equities, derivatives, and indices. This is true in all charts, from 1-minute bars through monthly displays. Markets spend the balance of time absorbing instability created by trend-induced momentum. Swing traders see this process in the wave-like motion of price bars as they oscillate between support and resistance. Each burst of crowd excitement alternates with extended periods of relative inactivity. Reduced volume and counter-trend movement mark this loss of energy. As ranges contract, so does volatility. Like a coiled spring, markets approach neutral points from which momentum reawakens to trigger directional price movement. This interface between the end of an inactive period and the start of a new surge marks a high-reward empty zone, EZ, for those that can find it. Prior to beginning each new breath, the body experiences a moment of silence as the last exhalation completes. The markets regenerate momentum in a similar manner. The EZ signals that price has returned to stability. Because only instability can change that condition, volatility then sparks a new action cycle of directional movement. Price bars expand sharply out of the EZ into trending waves. Swing traders use pattern recognition to identify these profitable turning points. Price bar range, distance from the high to low, tends to narrow as markets approach stability. Skilled eyes search for a narrowing series of these bars in sideways congestion after a stock pulls back from a strong trend. Once located, they place execution orders on both sides of the EZ and enter their position in whatever direction the market breaks out. Paradoxically, most math-based indicators fail to identify these important trading interfaces. Modern tools, such as moving averages and rate of change measurements, tend to flatline or revert toward neutral just as price action reaches the easy trigger point. This failure reinforces one of the great wisdoms of technical analysis. Use math-based indicators to verify the price pattern, but not the other way around. Volatility provides the raw material for momentum to generate. This elusive concept opens the door to trading opportunity, so take the time to understand how this works. Technical Analysis of Stocks and Commodities magazine describes volatility as a measure of a stock's tendency to move up and down in price based on its daily price history over the latest 12 months. While this definition fixes only upon a single time frame, it illustrates how relative price swings reveal unique characteristics of market movement. Rate of change, ROC, indicators measure trending price over time. Volatility studies this same information, but first removes direction from the equation. It stretches waves of price movement into a straight line and then calculates the length. Volatile markets move greater distances over time than less volatile ones. But this internal engine has little value to swing traders unless it can contribute to profits. Fortunately, volatility has an important characteristic that enables accurate prediction. It tends to move in regular and identifiable cycles. As prices ebb and flow, volatility oscillates between active and inactive states. Swing traders can apply original techniques to measure this phenomenon in both the equities and futures markets. For example, 10 and 100 period historical volatility studies the relationship between cyclical price swings and their current movement. And Tony Crable's classic study of range expansion, day trading with short-term price patterns and opening range breakout, predicts volatility through patterns of wide and narrow price bars. Cross-market analysis. Market action spins off both internal and external pattern cycles. Swing traders must consider both factors before executing their positions. The complex interplay of world markets works its way downward into individual stocks and futures on a daily basis, but accurate prediction of the exact impact during any given session requires a detailed understanding of macroeconomic forces and arbitrage between different entities. Consider the influence of the credit and futures markets before entering an equity position. A sudden sell-off in either of these exchanges can have an immediate effect on stock prices. Arbitrage between equities, futures, and credit also leads to intraday oscillation that runs through all exchanges. Observe this rhythmic movement on tick registers and in the cyclical price swing that runs through all major indices. Swing traders can use this well-known phenomenon to time executions that synchronize with these larger forces. Local influences change quickly from day to day. The markets constantly seek leadership. In the absence of larger forces, that role can shift at any time from the S&P futures to NASDAQ to the Dow 30 industrials. A major sector can suddenly move into the limelight and carry other markets higher or lower with little warning. These fluctuations may or may not affect any individual position. The swing trader must determine the potential impact quickly and shift strategy when required. Cross-market influences shift between local and worldwide forces. During quiet periods, simple arbitrage generates primary influence, but world events or broad currency issues may rise to the surface and shock American markets. Always defend active positions by staying informed and planning a safe exit in the case of an emergency. Avoid overnight holds during very volatile periods, and think contrary at all times. The best opportunity may come right after the crowd jumps for the exits. Follow the charts of the major indices and S&P futures on a daily basis. Intraday traders should watch their real-time movement throughout each session. Keep track of the current bond yield and identify major support resistance levels. Identify market leadership as early in the day as possible. Then use that price action to predict the short-term flow of the market. When a macroeconomic event appears, consider taking the day off, unless a clear strategy emerges to capitalize upon it. Promising setups often fail badly on these days because they can't find the crowd to carry them. Reward risk. Swing trading requires a serious commitment to skill, knowledge, and emotional control. Treat it as a business at all times. Prepare a personal trading plan, carefully evaluate risk capital, and set attainable goals for the future. If personal bias expects this discipline to earn quick wealth, find another hobby immediately, or just take up gambling. The markets have no intention of offering money to those who do not earn it. And always remember this valuable wisdom. Attention to profit is a sign of trading immaturity, while attention to loss is a sign of trading experience. Show a willingness to forego marginal positions and wait for good opportunities to appear. Prepare to experience long periods of boredom between frantic surges of concentration. Expect to stand aside, wait, and watch when the markets offer nothing to do. Accept this unwelcome state as all successful participants do. The need for excitement makes a very dangerous trading partner. Careful stock selection controls risk better than any stop-loss system. Bad timing does more damage than sustaining large losses. Make wise choices before position entry and face less risk at the exit. Watch out for secondary gains that have nothing to do with profit. Trade execution will release adrenaline regardless of whether the position makes or loses money. Always face your true reasons for swing trading the markets. The primary motivation must be to aggressively take money out of someone else's pocket. Rest assured, the skilled competition will do their best to take yours at every opportunity. Every setup has a price that violates the pattern. The measurement from this breach to the trade entry marks the risk for the position. When planning execution, look for levels where price must move only a short distance to show that the trade was a mistake. Then expand this measurement to find the reasonable profit target, and apply this methodology to every new opportunity. Limit execution to positions where risk remains below an acceptable level, and use profit targets to enter markets that have the highest reward-risk ratios. Each swing trader carries a different risk tolerance. Some find comfort flipping New York Stock Exchange behemoths, while others play low-float screamers. Follow natural tendencies, and remember that swing strategies use discretionary entry. The trader alone must decide when to enter, exit, or stand aside. Test overall results by looking at profit and loss at the end of each week, month, and year. Good results make money, while bad results lose it. Mastering the trade. Consistent trading performance requires accurate identification of current market conditions and the application of appropriate strategies to capitalize upon them. Pattern cycles provide an effective method for price discovery through all charts and time frames. This expanded concept of swing trading offers diverse tools to uncover profit opportunities through continuous feedback, regardless of bull, bear, or sideways markets. But information does not equal profit. The markets have a limited number of opportunities to offer at any given time. Price charts evolve slowly from one promising setup to the next. In between, they emit divergent information in which definable elements of risk and reward conflict with each other. At times, this inconsistency yields important clues about the next trade. More often, it represents noise that must be ignored at all costs. The ability to tell the difference between the two marks an important passage on the road to trading success. Trading noise occurs during both positive and negative feedback. It simply represents those periods when participants should remain on the sidelines, rather than jump into the action. Account capital has...
Sample complete. Ready to continue?